What's going on, YouTube? Welcome back to Goofy Investing, where we talk about investing in the stock market. This video is going to be about SOFI, what I think about the equity, what are some things that are headwinds, what are tailwinds, um, moving forward, what do I see with price action, performance, etc. We're going to get more into the derivative financial instruments of things and how it correlates to stock price and my thesis going forward. All right. So, SOFI, let's dig right in. Okay, we'll go to the financial statements. We'll go to quarterly financials. We're going to go to net income because this company is profitable, and we're going to be based off. We're getting judged off EPS heavily by Wall Street. All right. So, when I look at net income, all right. Well, first of all, let me go to the summary. You notice SOFI has a yield of 0% for their common stock, as seen by Seeking Alpha, and the actual value of different stock platforms. You'll go on there and they'll have an actual yield right there. That's for common stock dividends. All right. However, that doesn't necessarily paint the whole picture of if a stock doesn't pay dividends or not. All right. Like I said, let's go to the financials. We'll go to our income statement. We'll go to net income. As you can see, there are preferred share dividends right here under the net income. All right. If you recall the announcement from SOFI, that they are actually redeeming these preferred dividends. Let's talk about the measures of the effect of that, because the effect of that is going to start kicking in with the further quarters. Okay. We'll go to the balance sheet. All right. We'll go to a quarterly balance sheet and we'll go down here. Preferred stock redeemable. All right. They have redeemed, from what I'm tracking, they have redeemed all their preferred stock. All right. So what does that mean? All right. If you go to cash flows, or actually, yeah, let's go to cash flows. All right. So you see these actual common stock and preferred dividends paid. That's the combination of both C-class shares and preferred stock share dividends combined on the actual cash flow statement. All right. SOFI doesn't pay dividends on the common shareholder, and soon to be, they are no longer going to be paying dividends on preferred shares. Okay. So we'll go back here. Now let's talk a little bit about the differences and how it affects the equity and so forth, and how these dividends are paid out on an accounting and business measure. All right. Your common stock dividends, all right, which are paid to C-class shareholders, the common stock, if you will, are paid. Typically, they are paid through the free cash flows of a company. All right. If you have preferred shared stock, they are not paid through the free cash flows. They are paid through the net income of the company. And a lot of these preferred stock dividends are paid through the net incomes regardless of if the company is profitable or not. All right. So even if the company has negative earnings and they have a deal with preferred shareholders, those preferred shareholders are still going to be paid out those dividends. And the company will have to cut through other operational measures and liquidity to compensate for those preferred shares. All right. Let's look at the details of the preferred shares. All right. Let me see here. Okay, here we go. All right. So these actual shares that were redeemed, all right, these Series 1 preferred shares, initially when the deal was brokered, they were actually at a fixed rate to 12.5% yield on the actual preferred share equity itself. Now, The actual, there was no redeemable date, all right, but they were just redeemable in general. So the company could redeem them at the company's leisure or convenience, if you will. All right. And actually, when this actual deal went down, 12.5% yield based on fixed rate LIBOR. All right. Based on an actual variable rate of LIBOR. Let me explain that. So LIBOR is based off interest rates against the British pound. All right. So whoever was brokering the deal, whoever has these preferred shares, were bearish on the actual US dollar. All right. They were bearish on the dollar and they were bullish on LIBOR. All right. They thought that the pound was going to increase. All right. So there's a variable fixed rate or there's a variable rate against the spread of 9.93%, as you can see here, per annum, which is annually. All right. And these actual rates are refreshed, all right, on the fifth anniversary of from May 29th, 2019, May 24th, May 29th, 2024. So the amount of LIBOR, these investors were right, there was going to be an increase due to the actual rate of LIBOR, and it would affect the rate of the preferred share dividend being paid out. This is actually correlated, the actual preferred shareholder dividend buying power of cash, all right? How do I say? You know how we fluctuate, where we have high interest rates in the United States, so it increases the buying power of the actual US dollar, okay? These actual preferred shareholders cared about the buying power of their preferred share dividends, of their cash, all right? So they wanted to fix and hedge their buying power moving forward, all right? When they received a dividend, they wanted that dividend to have the as equal as much as possible of buying power from when they first started the deal. If you recall, back when this deal was done in 2019, 2020, interest rates were really low, okay? So the US dollar was weakening, and that's probably why they were bearish on the US dollar and decided to opt for LIBOR. All right, I'm not going to explain the differences between SOFR, LIBOR, how they correlate with treasuries, and how that all works. That's a whole long thing. If you're interested in that, check out my Patreon. I got all different types of instructionals that talk all about that stuff. All right. So, anyway, going back to it, what does preferred shares do to an actual equity? And how do preferred shares actually fluctuate with their capital appreciation and so forth? All right. So, preferred share dividends eat off the net income, so there is less net income available to the common shareholder right here. All right. So your preferred shares that are being paid out are subtracted off the net income, and then the real bottom line becomes the actual net income available to the common shareholder, and then that's calculated into the true value of EPS. All right. Think about it in terms of energy. When the company is paying out these preferred shares, the equity is losing energy. All right. The energy contribution of the earnings is subtracted from these actual preferred dividends being paid out. Since these preferred shares are redeemed, we're not going to have to deal with this line anymore. Okay. So they were redeemed like May 29th or so, before the earnings. So there probably may not be one more dividend payout. All right. I'm going to be looking forward to that. Looking forward to looking at that earnings statement once they report earnings upcoming at the end of this month. All right. This has put a drag onto the actual equity itself, because analysts would actually price their actual earnings expectations. All right. And the actual analysts, financial institutions will see that. All right. and then they will use that as an excuse not to increase the equity, all right, or the stock price, or market makers would use that as an excuse not to price the stock higher, all right? So I'm bullish there because that's going to be gone. I'd like to see more balance sheet management. I'd like to see SoFi get into a more net cash position. I am not basing SoFi's valuation based on tangible book. All these other investors on YouTube and all these other investors in general, if they're running financial models into the future based off the tangible book, they are investing with the expectation that this is going to be a bank, all right? And I don't think that, I mean, and how do you say, in all due respect, I think they don't know what they're doing, okay? The real value is going to come from that fintech platform, Galileo, Technisys. When that actual pie of revenue starts to increase and contribute to a portion of SoFi's revenue, this actual bank of today will become a fintech of tomorrow. That is my bullish thesis. When that actually happens, and the EPS, mind you, Wall Street can ignore this stock for a long time, all the way up until the actual EPS is starting to hit the bottom line, all right? When the shares are actually earning, all right? When that happens, the valuation's already going to be suppressed. My thesis is institutions are going to start coming in, they're going to start buying, and then an investment banker, if you've been following my channel, you should know the job of an investment banker is to sell the equity for as high as possible. So these institutions will come in, they'll buy the equity, right? All right. And then once they have their positions built, they will spin another narrative, and they will say, oh, this is now a fintech. And with that fintech, they're going to get a multiple. Is it going to be a full-blown tech SaaS multiple like Palantir looking at 27 price to sales? No. Okay. I believe it'll be a hybrid multiple. Fintech multiple will go to our valuation. I'm expecting price to sales on the hybrid fintech multiple to be landing at 9 to 10 times sales. Okay. That's just my take on my bull thesis on actual price action and future valuation. All right. Um, and now remember, with the redemption of these actual preferred shares, board seats have been affected to where there were some board seats that represent the preferred shareholders. All right. So with the preferred shareholder seat eliminated, the actual balance of powers to be, all right, within the actual company will be more focused and shifted more towards the common shareholder. All right. And if you've been following along, you should know that Noto has been buying a lot of common stock. So the CEO is bullish on the common stock. All right. We go to our summary. We look at price action. We're starting to see some increase in price action here on SoFi. I think this will continue. Now, what's one other derivative out there that I think would serve as more sell pressure against SoFi's equity? All right. Well, it's going to be these warrants right here. All right. These warrants are going to be due to expire 2026, May 27th. And these are actual convertible. These warrants are convertible at $11.50 a share. All right. So there is going to be more selling pressure at $11.50 a share. Does that mean that SoFi can't surpass that and overcome the actual selling pressure and conversions of those warrants? No, it can blow past that if there's enough scale. Okay, let's look at my actual position, and so that you know that, hey, I mean, I got skin in the game with my analysis too. All right, so I got 2,000 shares, cost basis $7.75. All right, so I would have increased this, but the warrants kind of got me a little iffy. So, and I found another better opportunity. So I'm actually leaning into Navitas right now. But I am a SoFi bull and I am keeping track of the stock. So I haven't put too many videos out there on my channel because it's all over YouTube. All the other YouTubers are covering SOFI, and maybe they're probably feeding a bunch of crap out there. I don't know, but whatever. If you're finding value in this actual YouTube channel, or you found value in this video, consider subscribing and thumbs up. Check out my Patreon here. Join the Looney Syndicate. Be with like-minded investors. Expand your mind, sharpen your skills as an investor with the coaching. You'll get access to the hidden gem collection, instructionals with different spreadsheets and how to use them. You get those actual tool products in perpetuity, so you can download them right to your desktop. And I'm actually adding more and more as we go along. All right. And you get more direct access to me. All right. So with that being said, thank you all for your time, and stay bullish and long, my friends.